Welcome to Creator Finance, and today I'm going to be talking about the Creator Risk Scale. I'm going to be going over two of the most impactful books I've ever read on how to make structured decisions. This genuinely can be one of the most important things that you ever learn. A bad decision can cost you years of your life and 6 or 7 figures. I'll then also be explaining what the traditional financial industry gets completely wrong in relation to risk and give you a framework how to think about this going forward. Let's go. This is Creator Finance, the only financial planning podcast built for creators by a creator. Here's what most financial advisors will tell you. Get a proper job with a steady income. Here's what I'll tell you. Being a creator or digital entrepreneur could make you wealthier than any 9 to 5, if you know what you're doing with your money. My name's George Agan, I'm a creator and chartered financial planner, and this is where creative freedom meets financial freedom. So, hi everyone. You may well have noticed that there was a slight break from the standard cadence. So what I'm trying to do with these episodes is do them every single week. And we got to Thursday, I think it was the week before. And it ended up going out the Monday afterwards. So only a few days late. I promised to be really transparent on this channel as far as what was going on. We were battling the second substantial nursery plague, the great nursery plague of 2026. So my son started nursery in January. Me and my wife, who's the person who edits this podcast, we were hoping that this would give us a lot more free time. We then subsequently learned that nursery is just a petri dish of plague. And we've been ill. He's been ill. It's been a real challenge, if I'm being honest with you, just because it's completely knocked us for 6. And that's one of the reasons why there was a slight delay in the last week's podcast coming out. We are sincerely hoping after neurovirus, COVID, that we have turned a corner. But yeah. Fingers crossed anyway. But that's why there was a slight break in the consistency. So without further ado, and after hearing my nursery lament, let's get on to markets.
My question is, how do you time the big market moves so well?
We haven't the faintest idea what the stock market is going to do or timed anything.
There is only one very quick comment that I want to make on markets. Now, when this will go out, it will be some probably point midweek. Now, the only thing that's been really interesting that's happened over the weekend is the Supreme Court ruled on a 6-3 verdict that Trump's tariffs, as in what he famously came out and said on Liberation Day, were the highest tariffs in the US since the 1930s, are illegal. And we have no idea, this is what's so interesting, I have no idea at time of recording how the market is going to react. Trump has subsequently then come out and said that he is going to apply 15% global tariffs. And we have no idea what's going to happen in relation to overall market reaction to it. If I was going to make a bet, I think the market is going to be very unsure how to price this. What I'll do is that we will put on the screen now what actually has happened, and you can all laugh at me for how wrong I got it. But I think it's going to be just another one of those kind of Trumpian things that seems to be happening in the markets, where the market's just really struggling to price in just the nature of volatility around the decision making. I think long term, it's going to be seen as another issue for as far as credibility. We saw last year one of the big kind of emergent themes was the depreciation of the dollar, certainly in global terms. If you have a look at, for example, if you were an S&P 500 holder, one of the big things is actually dollar depreciation had a really big impact on the returns. So while the general headline returns of the S&P wasn't quite as good as other European markets, but it was actually much worse when you adjust it back into, say, a currency like sterling, because you did see that dollar depreciation. So it's going to be an interesting one to see how it pans out. If I was to make a call as of today, prior to markets opening on Monday, I'm going to say that the market effectively doesn't know how to price it and shrugs it off. However, I will, as I said, I'll put on the screen right now what has happened, and we can all laugh at me as I probably all have got it wrong. So without further ado, because that is a big question mark, let's go on to the core creator finance topic, what I call the creator risk scale. So why is it so important to think about risk and structured decision making? And this is something that, if I'm being honest, I've tried to really commit to learning as many frameworks as I possibly could, not only because as a financial planner, it's so core to my responsibility. People are quite literally asking me with their life savings to make decisions based on judgment and making the right decisions. So the way I feel on my shoulders is quite high to make sure that I really consider the impact of the decisions that we're making. And that has led me throughout my career to research and read into the things that are so interesting about making sure that we make good financial decisions. I don't think we can actually overstate this, because if you think about it, if you're, for example, whether you're a digital entrepreneur, if you're starting a business, whether you're hiring someone, if you make a fundamentally the wrong decision based on the wrong premise, and we don't want to beat ourselves up, there is no crystal ball, but there is a definite opportunity cost there, because you've either wasted the time in relation to the decision and not got the return you wanted, so there's a cost there. There's also an opportunity cost associated with that. Had you been doing something else, then you could have also been investing your time and resources, and our time is finite. So I think it's always important when we're making these big decisions to try to do everything we can to increase the probability that we're going to make the best decision possible. And the two books that have been most seminal to me, one has been a book called Against the Gods, and the other is a book called Thinking in Bets by Annie Duke. They're completely different. One is by an economist who has been literally did all the academic history on where have we got this theory of risk and probability. Annie Duke's is a more unusual one. She actually is a professional poker player, and as the name suggests, Thinking in Bets is all about how can we ensure through our lives we give ourselves the best probability of making a good decision. Risk is something that is just so innately human. It's something we've always known even before things like Lloyd's of London and all these insurers were around. And the fact that there are some elements of outside of our control has been so central to humanity's development. It's only really in the last couple of 100 years that we've really started to quantify what risk is. Before 1654, people genuinely believed that the future was in the hands of the gods, that risk couldn't be calculated, it had to be endured. Now, this all changed because a gambler walked into a mathematician's study. His name was Chevalier de Mer, and he had a problem. Two players in a dice game had been forced to stop early. How did they split the prize fairly? He brought this question to Blaise Pascal, and in a series of letters with another mathematician, Pierre de Fermat, something really remarkable happened. They invented probability. For the first time in human history, we could place a mathematical value on the future. Not certainty, but expectation. And that changed everything. It's why you can buy car insurance today, why your pension funds can plan decades ahead, why financial planners like me can model your income with 30 years of uncertainty. A few decades later, a Swiss mathematician called Daniel Bernolio went even deeper. He noticed something that pure maths couldn't explain. Two people offered the same gamble would often make completely different decisions. And his explanation, which is something that links to what I've talked about as far as a theory of wealth and Warren Buffett, it's not about money. It's what about money means to you. He called this utility. And it's why if you have £1 million in the bank, another 1,000 feels like nothing. But if you have nothing, that 1,000 could change your life. The example I gave with the Warren Buffettism is that because he is on borrowed time, because he's getting towards his mid-90s, ultimately another billion doesn't really mean anything to him because he doesn't have the time to spend it. However, if someone said you can give away all your money and you can be 20 again, the utility of that money compared to time completely changes. This is why risk for us humans isn't a number, it's personal. And this gets really relevant for people as we approach financial freedom. There's also something called the law of large numbers. It's a mathematical principle that over time, randomness evens out. Stock markets don't go up every year, but over the long term, they've consistently moved upwards. Now, in the book, Bernstein, who wrote Against the Gods, his theory is we now have 300 or so years of mathematical tools to measure and manage risk. The problem is we're rubbish at using them. Bernstein argued that there is a big difference between risk and uncertainty. Risk is something you can quantify. Uncertainty is something that you can never really quantify. Let me give you an example. If you have 1,000 houses and it's in a certain location, an insurer can quantify the risk that one of those houses is going to get set on fire or flooded because they have a mathematical set that they can base probabilities against. Now, uncertainty is something that we just can't model. So an example would be, what would happen if AI is going to change the future of the world and completely change our workforce and how we interact with technology? That isn't a risk to be managed. That is pure uncertainty. We have no historical reference that we can plug against that. Yes, we've had technological revolutions. Yes, we've had things that have changed. But we can't, there are too many variables here that it's pure uncertainty, not a calculatable, repeatable risk. So Bernstein in his book Against the Gods really talked about our human interaction and the maths behind what risk is. So just to go back to Annie Duke was one of the world's top professional poker players. But before that, she was a PhD student in cognitive science. And that's when she discovered that our brains were wired for survival on the savannah, not making probabilistic decisions about pension drawdown and how much to save. She noticed something that poker players and investors do consistently. They judge their decisions by their outcomes. And she uses a great example in the book. In February 2015, Seattle Seahawks in the Super Bowl, they were on the 1 yard line. 26 seconds left. They needed a touchdown to win. And what happened is the coach said, instead of handling the ball back to their star running back, Pete Carroll calls a pass play. It got intercepted. They lost. Their sports pundits in America call it the worst call in the history of the NFL. But here's what they missed. Statistically, an interception in that exact scenario happens less than 1% of the time. If the pass is caught, which it almost would have been, Carroll looks like a genius. He wins the Super Bowl. The outcome was bad, but the decision was actually pretty sound. Duke in a book calls this resulting. We judge the quality of a decision by what happened rather than by the quality of the thinking and the time. This, interestingly, is exactly what the military does. When the military judges decisions, they decide that they're not going to judge it against the outcome, which could have been good or bad. They judge it based on the quality of the decision making, based on what the soldier had available to them as information at the time. Resulting is everywhere. We do this constantly with ourselves and our money. If we happen to invest in something really speculative and it goes up and we make a ton of money, we think we're a genius. Even if actually when we boil it down to the information we knew at the time, it was a complete punt. We rationalize these things in hindsight. Another great example that I actually ended up doing a blog post this is probably like 4 or 5 years ago. And this is a guy from Cliff Asness who runs a hedge fund. And he's an academic finance nerd. But he did an article called When to Pull the Goalie in Ice Hockey. So if you don't know ice hockey, and I don't really, pull the goalie is the ice hockey version of what happens in football when you send the keeper up for a corner. And he ran the maths on the impact. So what happens is the goalie runs out of the net in ice hockey and the other team are statistically much higher to score because you've just left your goal wide open. However, it does also significantly increase the probability of you scoring because what happens is you've got another player in attack. Now, he ran all the analysis in ice hockey as far as when people pulled the goalie, how likely were they to score, how likely were they to lose a point. And bear in mind that when you're doing these things, when you're deciding to pull the goalie, you're doing it because you are behind already. And he worked out that there was something consistent. Pulling the goalie was effective, but it's just that people had been doing it way, way too late. And I actually ran the figures in football and the maths was god awful. So I'm not going to claim any kind of structural position with the maths here as far as it being right. But even just looking at it against kind of football time levels, what this would have meant is this is like sending your goalkeeper up for a corner to score when you're 2-0 down and it's the 75th minute. Now, how many managers would ever do that? They would ever send their goalkeeper up at the 75th minute mark of the 90. They wouldn't. But it's not necessarily because it's a bad outcome. It's because people get sacked on the basis of what we perceive being their decision making, not necessarily what is statistically a good decision. Coaches kind of keep their job for looking like good coaches and good decision makers, not necessarily making the best decision at the time. And in Cliff Asness' work, he says, if we were to just look at the statistics, people would be sending their goalie out way, way earlier. I don't expect that any of you listening to this are going to start making renegade decisions because a spreadsheet told you so. I think it's important, though, to bear in mind that when you're making decisions, always be thinking about probability. And think about, instead of it being this binary, I'm right, I'm wrong, think about it as far as how right or wrong you feel. If this was a bet, such as Annie Duke mentions in her Thinking in Bets, how confident are you it's the right move? I'm 70% confident. Now, that one shift from binary certainty to honest probability changes everything. And the reason why is because suddenly you're not defending a decision, you're assessing a bet you've made. And that's just a very different mental space as far as reversing the decision. It will feel uncomfortable at first. Most people spend their entire lives avoiding uncertainty. But if we're naming our decisions first, this can be our first step to actually managing it. So I want to talk about the bridge between maths and psychology here. And here's the practicals. Delivery of these decisions should feel calm and structured, like trusting an expert walking them through the decision. So we've got two things to think about: Bernstein's maths as far as the tools to quantify the risk, and Duke's psychology, being self-aware of the problem. So both Bernstein in Against the Gods and Annie Duke in Thinking of Bets, they lean heavily on the work of Thomas Bayes. He was an 18th century minister who worked out how to update beliefs as new information arrived. Here's like a too long didn't read version. You start with a belief, new information arrives, and you update. Now that sounds really obvious, but here's where so many investors get wrong. Let's say you bought a fund or you invested in a friend's business based on a thesis. Maybe it was focused on property and the growth story made sense. That was your initial bet. Then the market changes from under you. Your original thesis disappears. Interest rates spike. The reason you made your investment no longer holds. What do most people do? Well, they hold on because they're emotionally attached to their decision, because selling feeling like defeat. Now, where Bayesian updating, what that tells you to do is you then go, well, the bet has changed, so update your position accordingly. Not out of panic, but because the information has changed. So in planning for our finances, this is all about updating our plan regularly, not obsessively, but with clear triggers. If something material changes in your decision making, you need to update. It's not about panicking, it's about having a structured review and thinking about things in the context of probability as opposed to certainty. And Annie Duke also mentions something amazing in the book called the pre-mortem, and it comes from something really simple. Instead of asking, is this decision going to work? Imagine thinking it's already failed. Imagine it's 2 years from now and your creative business has gone wrong, not slightly off track, seriously wrong. Now ask, why did it fail? Your brain will automatically start listing the real risks, the ones you've probably been quietly ignoring. Maybe the supplier issue you weren't expecting, maybe the single platform dependency that you haven't been thinking about. It's what Bernstein in his book calls the black swan problem. It's the risks that are outside of the normal distribution, the ones that don't show up on your spreadsheet. The idea of the pre-mortems is it taps into that slightly negative element of the human brain that makes you find issues before they find you. Okay, so here is what I think the traditional financial industry gets wrong about risk. And I appreciate this is happening on a podcast, so I'm going to do everything I can to try and explain it. Imagine you're looking at a risk scale. And at the bottom axis, the x-axis, that's the one under the floor, you've got risk. And risk is going from left to right. It's going risky and risky and riskier. Now, on the y-axis, the one on top, you've got returns. So returns starting at the bottom and it's going up to the top. And the higher you go up on the axis, the more risk you're taking. Now, how the traditional financial industry works, and this underpins what billions and billions of investments into which are basically directed by advisors and pension funds. This is how everyone in the most typical financial industry understands and quantifies risk. And what they will typically say is they will say, well, if you go up the risk scale, you go from things like cash, then up from there you have government bonds, because bonds are IOUs to governments and they have more risk but slightly higher returns, not much. Then as you go further up, you have more risk by having things like commodities, they have more volatility, but ultimately the returns are slightly higher. Then you have things like corporate bonds, property, and then as you get right to the top of the risk scale, so you've got high risk, high return here, you've got global equities, but then it's also widely acknowledged that individual companies higher on the risk scale, they can lead to lottery-like returns, but on average, extremely risky. And this is, and I'm just going to pop on the screen now, apart from that additional overview, an example from a risk profiling tool which shows exactly that. It's a number from 1 to 10. And as you go from 0 or 1, you're all in cash. And then what happens as you go up to 0 to 10 on the risk scale, you now start to introduce things like bonds and property and then get some more equity allocation. So if you say, like, I'm medium risk to a financial advisor, what that typically will mean is that you have 60% equity and about 40% bonds, some commodities, perhaps some property, depending on the investment philosophy of the advisor firm or advisor that you're working with. Now, if you're looking at this, and bear in mind that generally for a lot of advised clients, we're in this horrible situation, just being completely honest, from advisors, where we are judged by the regulator. We're also judged by the financial ombudsman. So if a complaint happened to occur and it wasn't resolved by the firm, the client then gets recourse via the ombudsman. And the ombudsman, they can often make decisions which are not in line with what a lot of professionals would do. It's one of those rare situations where the ombudsman may mean very well and they might be spot on a lot of their decisions. But a regular complaint from the financial advice profession is, well, we're being judged by people who aren't necessarily our peers because they don't necessarily have the qualifications or the experience to make those decisions. That is a fair thing that is often thrown as criticism for the ombudsman. Now, the counterfactual to that is the ombudsman may say, well, we don't need the qualifications because ultimately we're there just to look after the client and be impartial. But hopefully, however you feel about it, you can understand that there's a bit of a concern if you're sitting in the advisor's seat in relation to making sure that you're protecting yourself in a way that you don't fall foul from the decisions from the ombudsman, who ultimately make the final call. And those final calls can put you out of business. You know, if you have multiple complaints go through, it can mean that you can no longer get professional indemnity insurance. It can mean that you can basically no longer function as an advice firm. So the reason why I'm saying this is just to kind of lift the curtain back a little bit on the structural issues that are in place and why it's so important for advisors to be very cautious about risk in portfolios. Now, if we go back to that typical risk scale, my criticism of it is that this has shown one type of risk, and that is volatility. And volatility is a risk, it's a significant risk, but it changes over time. And I'm going to lean on the work of my good friend Andy, who he talks about the informed risk scale. And I just want to talk you through it because I hope at least as a structured thinking decision, it's going to help you really think about investment risk. So instead of just thinking about that typical risk scale where equities are really high risk and really, you know, top of the scale in relation to risk, so at 8 or 9 out of 10, I want you now to think about 3 different flavors of risk. So instead of saying that risk is all one thing, we're going to divide it now into inflation, volatility, and permanent loss. So instead of thinking of risk as just one single thing, we're going to split it into those 3 flavors. And one is inflation, where your purchasing power or your asset is being eroded by just the natural movement of economies and things that are getting more expensive over time. The next is volatility, which is a risk and is a concern. If things are volatile and they go down, and you need access to the money, you can basically cause that loss because you needed the money when the market was down. But the third one is then permanent loss. That's basically losing all your money. Put really simply, 1,000,000 times 0 is still 0. If you lose all your money, that is a significant risk. And what I'm going to do is I'm going to now imagine that being placed on the risk scale, but we're going to put inflation first, volatility second, and permanent loss third. Because inflation is a risk for sure, but it also does come with the fact that it can really dampen returns if you don't get returns above inflation. Volatility is a risk as well, but it is a risk that can be smoothed out over time using history of as our guide on most equity allocations. And then you've got permanent loss, which I think is the worst. And this is ultimately losing all of your capital. Now, what I'm going to do now on the screen, which I'll talk through for the podcast listeners, is we're going to put those 3 types of risk, inflation, volatility, and permanent loss, and we're going to now remap all those assets back onto it. And what you will see is that if you do that, the dynamic of the risk scale fundamentally changes. You now have, for example, low risk, low return cash, but it's going to sit in the inflation bucket. I've actually put a few other things on this as well. I put things like investing in yourself, because I actually think that is one of the highest return, lowest risk things you can do. I think investing in your business is one of the highest return things you can do. But make no mistake, your business could go under, certainly if it's linked to you. So there is permanent loss there in a way that might not be the case if you're investing in yourself. If you're building skills you can use for the rest of your life, I would argue it's one of the best uses of your capital you can get as long as you invest wisely. But the key shift is that all the other areas of global equity and property, things like that then start to shift to the middle of the risk scale as opposed to right at the end and being perceived as really high risk. Because global equity, property, even arguably some commodities, There is significant risk depending on how you set it up, but as long as you're diversified, all of history shows us that global equities generate the highest return over time, but you have to accept some volatility. Now, if we think about what is the area of risk that we want to really temper down in what we have as far as assets, it's permanent loss, isn't it? And the reason why I think this framing is so key is because then what happens is we're looking at our assets holistically. We're not just thinking about globally diversified equity or property or commodities or government bonds. We're thinking about this as we should as a creator or digital entrepreneur, about every asset we can have a look at. We are asset agnostic. It doesn't matter what we invest in. We just have to look at how we manage these different types of risk over time, whether it's inflation, volatility, or losing all your money. And where this is specifically relevant for creators or digital entrepreneurs is that it's that permanent loss cap area that we have to be so careful on. Because if you are over-investing in your business, if you're maybe then doing some angel investing on the side, if you also like your punt with individual companies, then you have an enormous amount of permanent loss risk in the event that that doesn't work out. Hopefully, they'll all, or one of them will be significant, benefit to the upside. But you are holding significant permanent loss risk in your personal portfolio. And we need to then look at diversifying it across other different types of assets, because 1,000,000 times zero is still zero, as I was saying. So I hope that's been useful to think about risk, because when I heard this kind of different way of framing the risk scale, it will make you think about risk profiling all over again. So if we just recap all the things that I've covered, we've talked about how risk is central to humanity. We've talked about resulting and how we need to judge the quality of our decisions more than the quality of the outcome. And that's one of the most challenging things to deal with. We talked about how, in my view, the traditional financial industry gets risk profiling completely wrong. And then we also talked about the 3 different flavors of risk: inflation, volatility, and permanent loss, and how important it is as an entrepreneur to look at the different sources of risk that you have in your personal portfolio and how you can manage those risks properly. And if I could say one thing just anecdotally from what I've dealt with entrepreneurs, is that the reason why they're successful is they often go all in. The danger of that is that often they then try and repeat that again and again and have too much permanent loss exposure. I want to be clear, I am not saying for 1 second that the highest ROI isn't in your business. Chances are it probably is. My question is, how do we manage that risk appropriately? So that is the creator risk scale. I hope that has given you something to think about. Thanks for listening.